Oh, hello. So I'll just have to stick close to the desk today. I apologize. All right, so we're picking up on analyze the accounting for stock warrants and record the proper entries. So first, a few things that we should know is that you record entries based on fair value percentage of the bonds and the warrants only when they're detachable. And the bonds, when the warrants not detachable from the bonds and record bonds as normally. I.e. no warrants. So why? Because bonds with warrants have both debt and equity characteristics. But non-detachable, submitted together. So you don't really have two things if you have to submit them together, if you want to convert them. So the journal entry, debit cash, cash received, debit discount on bond payable. This would be if applicable. Generally, it's not unless it's detachable, right? Put that in. Credit premium on bonds payable, if applicable. We have bonds payable, the face value of the bond. So the book does the entry separately when there is a detachable warrant. So you would have the extra entry would be debit cash to pay for the warrant. And you would credit paid in capital stock warrants. Okay. And do example 6 here. Okay. issued issued at 103,800 of its 9%, $1,000 bonds. Attached to each bond was one detachable stock warrant entitling the holder to purchase 10 shares of Lester's common stock. On December 1, 2021, the market value of the bonds without the stock warrants was 95. And the market value of each stock purchase warrant was $50. The amount of the proceeds from the issuance that should be accounted for in the initial carrying value of the bonds payable would be so let's look at what we've got here. So 800 times 10 shares. It's going to be 8,000 shares. Now we have 800 times 1,000 times 0.95 equals 760,000. 800. Yes, I'm sorry. Thank you. 800 times 50 for the warrants equals 40,000. And so that total is equal to 800,000. And we received 800 times 1,000 1.03. So that's 824,000. And we want to take the amounts. 824,000 times 0.95 equals 782,800. $824,000 0.05 is equal to 41,200. So this is the proceeds towards the bonds. And this is the proceeds towards the warrants. And so I like to do an entry. So we're going to debit cash. How much cash do we receive? 800. Excellent. 824,000. We had discount on bond payable. And so we know bonds face value equals 800,000. We assign 782,800 to the bonds. So this is sold at a discount of 17,200. We're going to credit bond payable of 800,000. And we're going to credit paid in capital for stock warrants for 41,200. Any questions on example 6? So, sorry, 782,800 would be the initial carrying value of the bonds, right? Is the initial carrying value of the bonds? Okay. Let's jump to example 7. Okay, so let's start with the cash. And so that's 2 million multiplied by 1.04. And so that's $2,080,000 in cash. And then you have 2 million times 0.95, which is what the bonds would be valued at without the warrants. And that's 1.9 million. And so 25 times 2,000 there's 1,000. Each $1,000 bond was issued with 25 detachable stock warrants. So 20 times 1,000 multiplied by 2 equals 100,000 for 100,000. 2,000. Trouble with the math in my head. That's 2,000 because it's 200,000 divided by 100. Sorry, math issue. So you have 2,000 $1,000 bonds that were issued initially for 2 million. So each one of those can be turned in for 25 shares. And the value of those is $2. There. To go back and find the spot where I recorded where I got that. Okay. So cash received was 2,080,000.95 for bonds. Just I get 1976, 1,976,000. And then for warrants, 2,080,000.05. $104,000. 2,080,000 is the total there, so we're good. So we're gonna debit cash. 2,080,000. Debit discount on bond payable. And the discount on bonds payable is the 2 million face value minus the 1,976,000 allocated cost. And that equals 24,000. Debt bond payable, 2 million. And credit paid in capital stock warrants. $104,000. We have an entry that balances. So what we did here is these are the fair values. So when you come back and look at these. You guys, practice number 3, I'll give you guys about 6 minutes and see where we're at. If you have any questions, please don't hesitate to ask. I'll be happy to come around. Anybody else need another minute? No problem. I don't mind. Okay, so we had $6 million in $1,000 bonds. So 6,000 bonds were sold. 6,000 times the fair market value equals the 1,008. This number given here, the company's securities had the following market values. And so that's 6,048,000. I just want to check. $6,048,000. And then you had 6,000 bonds times $2, 2 warrants per bond. And then you multiply that by 21, which is the fair market value of the bonds. That's equal to $252,000. So that total to the 6,360,000. And so we take percentage of bonds, fair market value equals 6,048,000. Did I math it? Where am I off on the math? Did you get?
6 million.
No, you're right, 6,300,000. Fair market value. And so we have the fair market value of the bonds, 6,300,000. Thank you for correcting me on that. And that equals 96.96. And so 0.96 times what we received, 6,360,000. And that equals 6,105,600. So if you were looking to allocate this based on that, you would have cash, and I'm gonna leave that, I'm sorry. If you're doing the entry, even though it wasn't required, you'd have, I'm gonna do it in two parts. You'd have debit cash for 6,105,000. You have a credit to premium on bond payable. And that's 105,000. And then you'd have a credit to bond payable of 6 million. And then the warrant piece of it. $254,400. So that would be cash. $254,400. Credit to paid in capital. Stock warrants. $254,400. So let's see. I did the 000 again. It should be 600 there. These problems are really challenging. Don't worry if you have questions, please ask. Work together as you're going through them. To start off with calculating that fair value based on the information that they've given you. When they tell you it would sell without those, that tells you that that's what the fair value of that particular one is. Can't even put contacts in. Watching me try to touch my eyes is just about the most hysterical thing ever. You're talking to a guy who took a hockey stick in the face. Successful now. Seen Florida. There's no hockey in Florida either. But everybody's Canadian in the hockey league. Few Americans, few Europeans. It's scratched everything. So. Yeah, it is the same, right? They're just asking for different parts of the same question. Okay, so let's look at practice number 4, and we want to find the fair market value because we have this lump sum purchase. Take that. I don't know what it was, but I know it now. All right, and so the bonds are 2,500 times $1,000 bond times 0.96. And 0.96 equals 2.4 million. 4 million. And then you have the warrants. You have 2,500 times how many shares? Now they don't have numbers. Okay, 20 detachable stock warrants. So 20 warrants times $2 per warrant. And so that should be 100,000. So total. Did I miss that again?
You broke it.
Okay, so total fair market value, 2.5 million. On percentage equals 2.4 million divided by 2.5 million. Six. And then you have divided by 2.5 million. 4.04. So cash paid was 2.5 million. It's 1.03. And so I get 2,472,000. Is that right? Oh, that's not right. 2,575. So 0.96 times for the bonds. $2,575. $2,472. So that tells us my debit cash for 2.472 million. Credit discount on bond payable. Leave that blank for now, and then bond. Pay for bonds payable. And that's 2.5 million. That's the face value, right? And so the difference is 28,000. And so you have a premium or a discount of 28,000, excuse me. And then what was the rest assigned to warrants? I'll just go ahead and answer this one. So we had 2.575 million minus the 2.472 million. And so that was 103,000. So we'd have debit cash, 103,000. Credit paid in capital, stock warrants, or 103,000.
Instead of.
You don't have to. I prefer to do everything in one entry, and my notes, I just have one entry, but the book likes to do them in both. So you could see either or on a homework question or on a test question. It's the, where it's just asking you this part of it or that part of it. So we still have about 25 minutes, and so we finished with this one. I've got another handout for you that I gave out. And so you guys should have number for some people, but if you don't have it, please let me know. I put it next to you, it's not because. To catch your breath when Stephanie gets back, we'll start on the next one. Isn't ruckus out there? Okay, so for those of you that are online, the next one is going to be the handout for chapter 15. And so you can just click on it and go right to it. I'm not going to worry about, why not? I give you 3 minutes to go through them and we'll do these. We'll discuss the questions. Okay, so let's go ahead and walk through these. Don't worry if you're not done. Again, they're just kind of testing your comprehension as you go through reading. While I always think it's a good idea at the end of the chapter to go through the key objectives. That's something that I even start with if I'm doing the reading, because I want to know what do I need to know before I need to know it. But we're talking here, and so keep in mind that these questions can be a little tricky. So the date on which to measure the compensation element is when the option is granted. And I want to just make a little note here, no entry is recorded on the grant date or stock options. The only one that we're going to make an entry to on the grant date would be restricted stock. Restricted stock has been becoming more and more because stock options. And they say, well, restricted stock combines is better with shareholders. Disagree because you're giving your compensation as effectively a value of the market stock. Right. So once they vest, they can sell that and still have money. Whereas a stock option, if they don't perform well and the company doesn't perform well, you're not going to buy the stock, right? So in my eyes, this is another case of management just finding a way to squeeze some dollars using stock out of the corporation. All right. Now, again, that's strictly my opinion, but what we're seeing now is it's basically they're guaranteed some type of compensation as long as they meet the vesting period if they do restricted stock versus stock options. Which is the following is an advantage of a restricted stock plan? And so be it never becomes completely worthless. What? Oh. I don't know. All right, which of the following is not a characteristic of an employee stock purchase plan? And in order for it to be a plan, it has to be available to everybody. It has to have a discount less than 5%. And it offers no substantive option feature. Which means you don't have an option in the future to buy the stock. Okay, with respect to computation of earnings per share, which of the following would be most indicative of a simple capital structure? So we're talking about earnings per share in this chapter. And we've got diluted earnings per share and standard earnings per share. If you have standard earnings per share and only standard earnings per share, it means that you have no other dilutive securities. So if your ownership only consisted of common stock, there would be no other dilutive securities there. If you have warrants, convertible bonds, and other structures, you end up having dilutive properties potentially. Now we'll talk about it because of the way that some of these are structured. The company actually, the EPS could go up on a specific transaction. In that case, that would not be dilutive. And the book does something that I really do not like. The book lumps two things together and then says, oh, because we come out dilutive, both of those are good. Well, that's not necessarily the case. You should really look at each one individually. Because one might be dilutive and one might be anti-dilutive. And so looking at it together is just bad logic. And I really think the quality of this book has gone down over the years, but it is still the premier intermediate accounting book. In computations of weighted average shares outstanding, when a stock dividend or stock split occurs, the additional shares are, and it's considered outstanding at the beginning of the year. Sorry, the earliest year reported. So if you were doing financial statements for 2025 and you have a comparative statement for 2023, you have to go back and adjust all shares to reflect the new shares outstanding. So if you split it 2 for 1 in 2025, you gotta go back and double those shares in 2024. Otherwise, the comparative wouldn't make sense to you, right? Because you would go from, and let's just throw a basic number in there. You know, if I have $1 million, or let's call it a billion, because it wants to throw it in there for me. I would just keep throwing zeros on. So in net income, less preferred dividends declared. And you divide it by, let's say, 10 million shares. That would equal 10, right? Thank you. Okay. And so I'm the same way. So now we have the next year. So this is, let's say, 2024, for example. 5, we do a 2-for-1 stock split. Even if we didn't make any of the changes and we still made the same earnings. Now all of a sudden we have 20,000 or 20 million. And so this should drop to $50. So you want to make sure that it's presentable. So if you have to do it, you have to do the earliest year report. So answers A, B, D, C, D. Hey, when something says non-GAAP, we should be aware of it, but we shouldn't use it in our financial reporting, right? So if they say what method is GAAP approved, you know, it's the fair value method. The intrinsic method is non-GAAP. And this is no compensation is reported if the stock or stock options are awarded. So these are set up to be awarded at current market rate. And basically companies used to be able to say, if we're giving you stock or stock options, we don't have to report any expense for it. So I believe, I'm going to use an old reference here, but FAS 95 is what changed that. And so that would have been the year that it is. I know it's now set up into a much more easy to use system, but back in 95, they changed the way that they had to report it. And so the fair value method requires the use of a fair value model to determine the value of the stock or stock options. Date of grant. In my experience, companies pay actuaries to make these calculations. It's nice when you're an auditor because if you're auditing them, that means that you're relying on their expertise and it's something that you do. And the same with management side of the defense, as long as you check off what information that they, these calculations, yeah, you go ahead and say, okay, as long as this, the actuary that did it are good folks, agrees with what's reported on financial statements. We don't have to know the exact ins and outs because the expertise of doing this is kind of beyond a normal accounting understanding. Not that there aren't plenty of people in auditing that know what's going on and are able to look at it, but in general, these are done by a third party, usually actuaries. And actuaries, if you're familiar with them, they kind of put everything together that's going on and they say, okay, what's the likelihood of an employee leaving? What's the likelihood of an employee dying? How much in historical have they exercised? And so they give you this number. What is your stock price doing? And they really use statistics to try to bring together a fair market value method. Okay. So there's a couple accounting issues that we should talk about. Fair value models. Recognize the likelihood that the stock will appreciate. Vesting rate of employees. The exercise rate. Etc. The period to allocate compensation expense gets recognized over the period compensation is earned or vested. Any questions there? It's okay, take your time and assess that. I'm trying to understand the interest rates. So basically, on the day they award you it, they're gonna tell you, you know, this is worth, as accountants, this is worth $100,000. But if it takes 4 years to vest, then what you do is you divide up the compensation and do $25,000 each year. And that's how it works. And we kind of ignore the small changes or big changes. When I was at United Technologies in a 3-year period, our CEO earned $250 million in stock compensation. So it can be huge numbers. Exactly. Right, so we'll leave here with 5 minutes left in the class and we'll pick up Thursday. Assess where we're at on Thursday. It's looking that I might need to push that exam down. Thank you, everybody on the Zoom. I will talk to you guys on Thursday. Have a great day.